Hello and welcome to Stockwatch Live. Now, after food delivery company Just Eat's tasty serving of a 43% rise in sales this week, it's a turn of Domino's Pizza to dish up something equally savoury. That, though, could be a slice too much for the pizza giant. At the end of January, Domino's shares fell almost 10% after it said full-year pre-tax profits will be at the lower end of expectations because of weaker sales in Norway and Iceland. It's a shame because despite UK diners largely losing their appetites for dining out, Domino's had posted growth of almost 6% year-on-year across the UK and Ireland over the summer. It seems pizza went down a treat even in the hot weather. However, the chain's overseas expansion plans clearly aren't going as hoped, and having posted a near 10% fall in first half profits, it's had many investors asking whether they have the stomach for more. Especially when it became evident that the company's international expansion plans were responsible for a big helping of the fall. When it posts full-year results on Tuesday, shareholders will want to know what's on the menu going forwards and whether the group has figured out a way to replicate, or maybe even ditch, plans to roll out its hugely cash-generative core UK franchise model to the rest of the world. For now, though, brokers are clearly cautious. Berenberg has downgraded its rating to sell and cut its price target from 260 pence to 220 pence. Liberum Capital is also sticking with its sell rating and has cut its price target to 210 pence. The saying goes that the only certainties in life are death and taxes, but the fate of funeral services provider Dignity proves that that doesn't necessarily translate into an automatic win on the stock market. Dignity shares are now more than 40% lower than they were in May last year. In fact, they failed to rally much at all since they took a less than dignified dive at the start of 2018. Trading around the 730 pence mark now, they're a long way from the peak of £28.70 they touched in October 2016. And looking at the latest round of broker notes, the share price isn't expected to rise anytime soon. Berenberg has repeated its hold investment rating and cut its price target significantly from £12.50 to just 700 pence, while Peel Hunt has reiterated its sell rating and also cut its price target by £1 to 700 pence. Dignity's financial reports always verge on the macabre. Pegging profits to a rising or falling death rate seems unpalatable, but the funeral business is still a business, and you can't afford to be squeamish about death if you hope to profit from it. In January, the company said it expected operating profits to beat market expectations and come in around £79 million because of higher than anticipated funeral average income and lower costs in the fourth quarter. But it didn't lift forecasts for 2019 because the company predicts that average funeral incomes will actually come in lower this year. It's all to do with increased competition, which is proving fierce. At an average cost of just under £5,000, funerals certainly don't come cheap, and here in the UK, Dignity has honed in on a lucrative gap in the market for dignified but more financially viable funerals. However, it isn't the only one. The cooperative group has also spotted the gap, and as a result it's been going head-to-head with rival Dignity on cost ever since. Now, there's been a lot of talk about the likes of film and TV streaming services like Netflix and Amazon sounding the death knell for traditional cinemas. That's something Cineworld, though, rejects. So it'll be interesting to see what it has to report when it posts full-year results on Thursday. The group, which became the second largest cinema company in the world in terms of screens when it acquired Regal Entertainment Group in early 2018, now has a large share of the US cinema audience. And that could prove to be crucial to its success and even its survival. Cineworld has already revealed that it experienced a slowdown in sales growth during the last few months of 2018. Revenues last year climbed 6.2% on a constant currency basis, which is a measure which smooths out volatility in the foreign exchange markets. But that's less than the year before's 10.2%. The slowdown was largely put down to tough competition in the same period year on year, when the final quarter of 2017 got a boost from the release of the new Star Wars film, The Last Jedi. Importantly, though, the group has seen its newly acquired US business coming up trumps. This past year was the highest grossing year for ticket sales in US history, topping 2018 by almost 10% and hitting the $11 billion mark in mid-December, which is earlier than ever before, according to industry analytics from Comscore. For Cineworld, that played out as a 6.9% increase in revenue at the US box office, while the UK and Ireland managed only 2.1%, which equated to a fall of 1.5%. Retail sales of sweets and popcorn were also up 9% in the US, compared to just under 3.5% in the UK and Ireland. There's been a lot of talk about cinema goers increasingly after an experience and not just a bog-standard film screening, and the company is working hard to improve, investing in technology that's hard for home viewers to replicate, like IMAX and 4DX, which includes sensory experiences such as wind, rain and scents. Also next week, keep an eye out for full-year figures from UK motor retail group Lookers, Morrisons Supermarkets, convenience store and local supermarket property investor Capital & Regional, and estate agency Savills. Half-year results are also due in from DFS Furniture and pub chain Wetherspoons. For commentary on these and the other companies reporting next week, go to the Markets and Insights section at fidelity.co.uk. See you next time.